Hey traders, hopefully you're having a good week so far. We're going to be going over dovish, hawkish, what it means, how we can analyze the policymakers and see where they stand between these two baskets. But first, for the start of the video, we're going to discuss what each of these different baskets mean or different groups that individuals could be placed under. And all it is two different monetary policies basically, or viewpoints that these people are going to be looking at. So the first one is going to be dovish. Now, what does this mean? Well, people who are dovish or doves are favoring more stimulus. So first off, ZIRP, this is zero interest rate policy. So they want to reduce the interest rates. They want to cut interest rates. And that would be a characteristic of a dovish individual or a dove. So dovish is like medium, and a total dove would be an extreme stimulus type of characteristic. And we can also see increasing money printing or increasing stimulus, similar to bailouts and bail-ins, would be considered a dovish move. And then they're favoring economic expansion. So right now, a lot of people are dovish. They don't want any recession. They don't want to raise interest rates. They just want to keep this economic expansion continuing forever. So a lot of people are currently dovish. They don't want a recession. They want to print more and more and more, make money cheaper and cheaper and cheaper. And that would be expanding the economy as well as expanding the balance sheet, right? So that is a pure characteristic of a dovish individual or a dove. And this is where we currently are right now. We're not really seeing any of this. We're seeing a lot of dovishness. Now, on the flip side, what is hawkishness? Hawkishness is going to be on the other side of that. So they favor less stimulus. So they are looking to increase the FFR, or the federal funds rate, which is also just called the interest rates. So ZIRP is zero interest rate policy. So they're going to have interest rates at zero. They don't have them right now. It's around 0.25%, but some countries around the world have zero or negative interest rates. And that would be a very dovish monetary policy. Whereas hawks would want to see increasing interest rates or federal funds rate in order to make money more difficult and more expensive to borrow. And hawks or hawkish individuals worry about high inflation, which we don't see right now. People are actually worried about deflation, where the dollar is too strong at this moment. But this is a hawkish characteristic, is a worry about high inflation. And due to the worry of high inflation, they're going to look for economic contraction. So if you're not stimulating, if you're not trying to push the economic expansion forward, obviously the contrary would be you would see a contraction. But not all contractions are a bad thing. If you have an economy that is running too hot, where you have too much inflation, CPI numbers are absolutely blowing through the roof, you may need some economic contraction in order to cool down the economy and stop it from overheating. And this would entail reducing the balance sheet, so taking money away from the pool of currency that is within an economy. So those are the two different situations. And right now, we're extremely dovish, where you have 0.25% interest rates in the United States right now, so 25 basis points. You have obviously lots of money printing, especially during maybe a month or 2 months ago when they were creating all the bailout stimulus checks sent out to every individual, all that stuff. That's obviously extremely dovish. Now, obviously, with this monetary expansion, money printing, there is worry of inflation, right? That's what everyone's talking about. Money printing equals inflation. So in theory, that is a major part of inflation, but there's a key factor that needs to play into the formula of inflation in order for it to actually be shown in the CPI numbers and overall everyday individuals purchasing goods and services. So this key factor is the velocity of currency. And we'll talk about that today. But first, we just want to get into the previous historic times when this happened. So we were during basically the 70s, we went from dovish to extreme hawkish, where in the 70s we see a picture right here. And this shows the CPI, which is Consumer Price Index. This is going to be the average cost for goods and services for all items. We can see all urban consumers. The red one's going to be the place that we want to keep our attention. The effective federal funds rate is increasing starting from around the 70s. We see it making higher highs and higher lows, even hitting the double digits in around mid 70s. It hit over 10%, went back down, and then absolutely exploded, and it went around over 20%. So it was extremely, extremely difficult and costly to borrow money because you have to pay 20% of what you borrowed. That's a lot. Whereas right now you're paying 0.25% of what you borrowed. If you're a commercial bank, that's basically what you're getting charged. So it's very, very cheap. So what happens in these situations? Well, obviously, it's not good. So let's get into it right now. So it happened in the past. We went from dovish to hawkish, where we saw increasing FFR, federal funds rate, and then increasing CPI. So let's get our Dow Jones. So this is around the same time as what we just saw, around the 70s to 80s. So because the federal funds rate was increasing, it's harder to get an economic expansion. It's not because money is more difficult to come by, right? If you have more money in a business, you can spend it on something, you can reinvest it into the business, and then one man's spending is another man's earnings or income, so then that person gets more money, and then the whole economic cycle is, I guess you could say, more lubricated with currency. But if you're taking currency away, it's going to be harder for business to grow due to the fact that it's harder for them to borrow money, and it costs more to borrow money, so they're not going to borrow as much, and it's not going to grow the business as quickly, and he's not going to be able to spend as much money on another service or product, and then that service or product. It's a whole cycle, but basically when you see interest rates rise, you don't see risk on assets go up. This is the Dow Jones during 1970 and the early 30s when interest rates were booming. They were exploding in the double digits and even 20s, where the stock market was completely flat. We're at a ceiling here at around 1065 for over a decade, right? But what happened during the risk-off environment in other assets, right? You see interest rates explode through the roof. CPI numbers explode through the roof. People are hawkish overall in the Fed policymaker group or whoever is in the Federal Reserve. They are overall hawkish. In that situation, what do you see do extremely well? You see stuff like gold. This is from the 70s to the 80s. It went from, let's say, 200 and under 250 bucks to over $2,000 in basically a decade. Silver, very similar situation. It went from, let's say, $10 to over $100. Right? Silver does explode more aggressively because it is a high beater. It's more volatile, yes, to the downside and to the upside. But that's why when we are looking at a metals bull run, silver is the place to be in my personal opinion. But that's the overall direction that I think we're going to be going. Is we're in an extremely, let's get right here, we're in an extremely dovish situation right now where we have zero interest rates. We have lots of money printing going on, not just in the United States, but central banks all over the world are printing shit tons of money, which is expanding their balance sheet. So this will have to come to an end sooner or later, in my personal belief. You can't have ZERP expanding balance sheet and economic expansion forever and ever and ever and ever. I don't think that's possible. There has to be some hawkishness or else inflation will run away, is the thesis. But there is some information that is countering, I guess, this initial thought that I have, and that is Japan. Looking at Japan. We do look at Japan quite often because they are quite an outlier in terms of their central bank, how much money they've printed, their debt to GDP, and all that stuff. So we'll get into it right now, but this is the argument for the worry of inflation in the United States. So let's now look at Japan, what happened in that country, and where it currently stands right now. All right, so first off, Japan has been in a dovish stance for an extremely long time. What does that entail, right? They have very low interest rates or negative interest rates. They're printing lots of money. They're expanding the balance sheet. These are the signs and characteristics of doves, right? So let's look at Japan. We initially see Japan's interest rate. Since 1989, this is where their asset bubble collapsed. They dropped interest rates really low in order to create lots of stimulus, lots of cheap money, and that's how an asset bubble is created. You get the big boom, and then people in the monetary heads of the country or economy say, oh shit, this is running way too hot. We do have to increase the interest rates, and that creates a huge bust, basically, because businesses are built around cheap money. Once there's a lack of cheap money to go around, a lot of businesses fail, and that kind of just creates a bearish momentum overall for the economy. And since then, since the asset bubble burst in 1989, end of 1989, look at where the interest rates have been for Japan. They've just been going down. A little bit of a move up in around 2007, but we haven't seen any real hawkish indications with Japan's interest rates, right? So you're thinking, wow, that's extremely dovish. Now look at their balance sheet. This is Japan's balance sheet all the way from 1970. 1989 right here was the asset bubble collapse in Japan. And then we see that they did print quite a bit of money back starting at 2000. But what really kicked it off is when they implemented their quantitative and qualitative basically QE program, qualitative and quantitative easing. So the America calls it QE, quantitative easing, but then Japan calls it QQE. But it's very similar in that they are expanding the balance sheet to purchase financial assets to create aggregate demand within a marketplace. So that is what they're doing basically. And we can see exponential boom in the balance sheet. So you have already the perfect setup for high inflation, right? You have the interest rates that are basically at negative or zero. So you have ZERP since the 1990s, right? Crazy. And you also have a ton of money being printed. So you're thinking, why in the world is the Japanese yen considered a safe haven currency? How in the world can it even hold value, and why are people using it? Right? How is it not hyperinflating like what a lot of people are saying America will have and the United States dollar will have? Because these are the two things that people look at most when considering inflation. But there is a third category that I think a lot of people are not focusing on. Yes, the people who understand economics, understand monetary policy and stuff, they will definitely consider the velocity of money. But people who might be just introduced to it, they don't really understand that velocity of money plays a vital role in inflation. And this is the velocity, or the velocity of M2 money stocks, or the velocity of the United States dollar. And we can see since the 2000s, it's been dropping. And what does this mean? The actual website says a little description here. The velocity of money is the frequency at which one unit of currency is used to purchase domestically, produce goods and services within a given time period. And if this goes down, people are transacting less with that currency, which is overall deflationary. You could print $1 trillion, but if it doesn't move from a bank account, if it doesn't move from an account, it's not circulating within an economy. So it's not going to impact the overall increase or decrease in the supply of the currency, because it's just in that account, not moving, not getting transacted within an economy. So theoretically, that money hasn't been introduced to the pool of currency within an economy, if that makes sense. So when velocity decreases, it's deflationary. It's harder for inflation to occur. You can see since 2000, yes, the United States has printed a shit ton of money, but velocity has decreased, especially since 2008 in the financial crisis. So you're seeing inflation having a tough time due to the velocity of currency decreasing. Now, in that said, Japan is unbelievable in that their velocity absolutely plummeted. So 1989, somewhere around there, that was the asset bubble collapse. And since then, we've basically seen almost it cut in half. So yes, the balance sheet is increasing substantially. Yes, the interest rates are extremely low in Japan, but the velocity, the M2 velocity for the yen is dropping to record lows. So they're not seeing the inflation that normally you would see if the two things are happening. Increasing money or money supply, as well as lowering interest rates. But the velocity is a key factor. And what impacts velocity, right? Well, first off, just the psychology of individuals greatly impacts the velocity of money. If more people are willing to go out, shop, spend, purchase things, go out and have experiences and all that stuff, that is going to increase the velocity of money, as well as businesses being able to purchase more manufacturing tools and products to help their business be more efficient and profitable and all that stuff. They're hiring people, they're getting paid more, they're spending money. It's a whole system and a cycle, and it kind of starts slow, but velocity is momentum based, right? So right now, the momentum is still to the downside. So unless it shifts, unless the psychology of the masses, corporations, individuals, companies, countries, the psychology of the masses, unless it shifts, this is going to continue to go to the downside, and we're not going to see the inflation that a lot of people are expecting, in my personal view. But hey, it could shift soon. We don't exactly know when it will. This is like very macro based, but that is the current situation we're in. So I don't think that we're going to have high inflation in the United States just yet because of the decrease in velocity. And we can see from experience that as long as the velocity of the currency is decreasing, they could keep on lowering interest rates, have negative rates, as well as print the shit out of the currency, and they can still have, not a lot of inflation or still in a deflationary spiral. And then you just get GDP to go sideways, not really seeing any strength, because yes, we're seeing a lack of increase in the velocity, business connections, and just overall creation of businesses and all that. But you see the government create aggregate demand just through buying financial assets. So it's kind of opposing each other, so then you're not really going to see that major inflation. And it's a pretty interesting thing if you actually read more about it and try to understand it. It's very fascinating. So that's going to be the macro fundamental kind of side of the video. And then we're going to get into the questions, and then we're going to jump right into the charts. So let's get this right here. And let's look at some questions that are within the TikTok, and then we'll jump right into the charts, looking at a bunch of different stuff. All right, so the first thing I actually want to go over before we look at the charts is this website right here. Give me one moment. This website right here, I just found this recently, and I think it's extremely cool. So this is the doves and the hawks of the Fed policymakers, and we can see this is from the influence, so it sorts by influence. So obviously Mr. Jerome Powell has the highest amount of influence, and we can see the little quotes here. So Mr. Williams says, "We've got monetary policy in the right place." So he's a centrist. He's not too hawkish, he's not too dovish, he's kind of in the middle. But we do see some individuals who want more stimulus, especially Kashkari. We can see that there's some quotes here from other people. Mr. Charles Evans said, "I wouldn't mind another cut. I could see it either way." So he doesn't mind a cut. He wants more stimulus. And there's some other people who are a little bit worried about inflation. Esther George, Kansas City president, said, in current circumstances, concern about low inflation seems unnecessary. So the concern for deflation, where the US dollar surges, stocks go down, that is not a worry in her eyes. The bigger worry would be inflation in her eyes. And I think this is really interesting because you can kind of see what stance each individual is taking. And obviously, America is a very, very important place to be looking in order to kind of gauge dovish, hawkish, because if people really start to become hawkish and they raise interest rates because there's worry of inflation, the stock market, I think, will move to the downside. If there is a reduction in credit and the difficulty to borrow funds increases, that is pretty bearish overall in my view. And we had that happen in 2018 when we had that massive meltdown within the S&P right before the end of 2018, start of 2019, where we had that massive sell-off. They were increasing interest rates. So it was more hawkish. So then overall, businesses would be having a more difficult time borrowing money. It would be more expensive to borrow money. And that overall is a little bit more bearish compared to just stimulus, cheap money, cheap money. That's obviously more favorable for businesses. So it's from Reuters. Just Google Doves and Hawks on Reuters, and I'm sure you'll be able to find it. Very interesting link that I think it's pretty interesting. Pama said Stephen Hawkish. Yeah. If he was alive today, he might be in this boat for sure. He's a pretty smart man. All right, so a little bit of the questions on TikTok. Also, if you have questions, throw them in YouTube or TikTok. I'll be answering both. 500 Cat Butt said, do a face reveal at Dow 15,000. I don't know if we'll do a face reveal, to be completely honest. We really enjoy and respect and treasure our anonymity. Very much so. It's great. Hi, what you say about XRP. So we'll talk about crypto in a little bit, but a quick note on XRP. We talked about it yesterday. XRP, fundamentally, in my opinion, they're doing the right thing. They are going through the regulatory processes, all the hoops and challenges in order to kind of be the SWIFT of the world, where they are the median of transaction on the global stage. Right now, they're using the US dollar and they're using the SWIFT system, which is obviously very centralized, XRP as well. But just in terms of fundamentally, I see where they're going and it makes sense. But technically speaking, they're extremely relatively weak. So if you compare XRP with other alts or BTC, XRP underperforms and has been underperforming for a while. If you're comparing XRP to Binance Coin, Cardano, Ethereum, Link, a lot of different coins, right? Pick your coin, and XRP is probably underperforming compared to it. So yes, later on, at a point in time, XRP could be dominant, could be relatively strong compared to assets like BTC, Ethereum, Binance Coin, all those stuff, right? But right now, I don't really see it as a strong cryptocurrency to be putting your capital in. That's just me. It could change, but right now, that's my view. Hugo said, is it going to boom over $1 this year? I do not think so. Obviously, anything can happen, but I really, really, really doubt that XRP will be going over $1 in 2020, my personal opinion. So that's the questions for TikTok. Let's now get into a little bit of the TA that we're going to be going over here so we can close that. Hopefully everyone knows kind of the idea that we're going with this is we're trying to get a good understanding of the current economic situation and where policy makers are kind of going with risk on, risk off. Is it easy to get money? Is it difficult to obtain money? How cheap it is to get money? Is it expensive to get money? All that stuff. So interest rates play a vital, vital role in an economy because it basically allows businesses and individuals to easily borrow funds or make it very difficult to borrow funds and expensive to pay back. So definitely a very key role. So let's talk about the S&P now going into the charts here. We did hit the target that we were looking for. Awesome, awesome move. Like, this is basically a perfect move to the upside here where you're breaking resistances, holding supports. You get a bullish engulfing candle to initiate the next strong push up. So what do I mean by this? So let's get our white. So initially, we got the descending wedge. We were looking at this either to melt to the downside if we were going to continue the risk off sentiment, but we held the support, broke the previous support and resistance for a new level of support right there, and that was when we were thinking that it was going to go back up to these highs here, just looking at the geometry of the wedge as well as major levels of significance to the left of the chart. And we can see right here, very, very strong. So Basically, we hit our target, which is great, and now we're just seeing it react to this zone. Obviously, the momentum is to the upside. When we were going up, we were making strong pushes where the buyers were definitely beating the sellers in each of the pushes to the upside. You see this bullish candle right here initiate the next strong push to the upside. You see that it did retest as a new level of support before pushing up and making a new high. And then exact same thing, previous resistance here, turning into a new support with a massive bullish engulfing candle to initiate the next leg higher. And then for the third time, you get a nice little retest of the previous resistance, new support before the last leg up. So it definitely looks like a strong move. You can also look at it as a potential 1, 2, 3, 4, 5, where the top of one is higher or lower than the bottom of the 4, and the third wave has to be longer than the first. So overall, it looks good in terms of the outlet wave. It looks good overall. I'm going to basically be looking at this from a consolidation standpoint. I'm going to draw a nice ascending zone right here. I'm also going to draw a horizontal zone right here. So now we could be trending here. We could continue to move to the upside, continuing its momentum, but I'm going to want to see the price at least respect this resistance and potentially a support zone, but that's going to be what I'm going to be looking at the market as. Right now, strong push to the upside. We're going to get some level of a correction consolidation, I'm pretty sure. Probably going to be respecting some resistance as a new level of support, and then we're going to be looking at this as a horizontal channel, so it could be kind of like a high base where you get a push to the upside. You see basing where there's a nice equilibrium between the buyers and sellers, and then once you see that break potentially to a higher high and then a higher low, that equilibrium is now not so balanced, and then you get the momentum to continue to the upside if we break the 3160 zone. So right now we're getting some hesitation. I like to see that. I want to see a little bit of a consolidation, and then we'll see where the price goes from there. It'd be nice to see 1, 2, maybe 3 support zones with a nice channel here, and then once you get that break and retest, you're looking for that validation of a new level of support, and then that risk on environment, in my opinion, will continue moving forward with the key level right here at around 3230, 3240 for the next level of resistance. So you got here to here, and then your stop loss potentially here if you consolidate a little bit more, push up, and then you got your higher low. So it's looking pretty good. It's looking pretty bullish. I'm going to be viewing the market as a risk on sentiment, continuing from when we broke this zone, as well as the confluence of this zone, and especially when we supported that zone for a new level of support. That's when I was really looking at the market for some risk on opportunities, looking at crypto, looking at FX, looking at S&P. Overall, great move within the market. So that was awesome. We're now going to be looking at some other indexes. The Russell 2000 has not yet broken the potential right shoulder, so the head and shoulders is still in play. It's just consolidating at around the 1470 zone and above the 1360 zone, just at the top of the right shoulder and the neckline. So we'll just see where the Russell 2000 goes. If this does break to the downside, so let's get rid of that because that price action pattern has now been completed and it has hit targets, so that's going to be the end of that structure. So now we're looking at the market kind of like this structure, where we see a series of higher lows squeezing the price towards a major level of supply at around 3157. So what we're going to be looking for is for the price to either break to the downside, breaking your support, in which we'd be looking for a potential risk off move, and if it breaks the resistance, we'd be looking for a potential risk on move. So it's not just the ascending zone, but we're looking at multiple levels of confluence where you're looking at horizontal zones in line with ascending or descending zones, and that's going to be the level 31, let's say 3100. If it breaks below 3100 again, that would be a bit of a worry for me. That is going to be another risk off sentiment where we'd be looking for some shorts within the S&P. BTC is probably going to be dropping, but if it consolidates, even if it breaks this ascending zone, as long as it's kind of holding the higher high, which is now going to be a higher low, resistance into support, I'm going to be pretty optimistic about this in terms of bullishness. So that's going to be my viewpoint. We're just right at a zone of sensitivity, so we're just testing that right now. The first push that we got here was pretty awesome. So we're going to wait it out. We're going to be patient, but that's going to be what I'm going to be looking for the rest of this week. And then the Russell 2000, we already talked about it. Not a lot has happened. Nasdaq has not really done much. It opened to a new high, breaking the previous all-time high right here, and this is going to be our new level of support because we see initial resistance, another resistance with a candle closure with a wick retracing back kind of to the middle of the trading range within that 4-hour time frame, and you get a big gap up, and then now you're just consolidating. We see a little bit of an island, so you could see a little bit of a pullback, and if it comes back down, an island's a pretty important reversal point if we are looking at some equities where there's a lot of gaps, obviously. But and if it pulls back, Nasdaq overall is indicating to me that it is currently a risk on environment. If you're looking to long any index, the Nasdaq is the place to be looking. If you're looking to short any index, I would say that the Russell 2000 or the FTSE 100 is showing relative weakness. Got the words mixed up. Relative weakness compared to the other indexes. Like you can see, the DAX is doing pretty well. The Nasdaq is doing extremely well. S&P 500 is doing pretty well as well. So that's the overall market. Volatility is dropping, so it makes sense in the overall risk on sentiment, where if volatility within the S&P is dropping, usually that is a confluence when we're looking at the S&P that it's a risk on environment. If the VIX is absolutely exploding, people are fearful, people are uncertain, people are worried. They're going to store more of their capital in cash or bills, bonds, US Treasuries, and that's the way that capital is going to be flowing. But if the volatility is decreasing, people are overall looking to speculate and will most likely put their capital in risk on assets and instruments like these global instruments and assets, or global indexes like we can see right here. So that's a little bit of the US equities. We'll get into the global equities very shortly. And we're going to get into that right now. We don't really see any more questions. I'm the only Zonut. Says hello. Hello to you too. All right, a little bit of some global equities here. Not a lot has happened too much, but we did see that the ASX, which is the Australian stock market index, and the DAX, which is the German stock market index, both made a push to the upside today. We are on the 1-day chart for all of, or except this one. This one's a 6 hour, so let's just bring it to the 1 day. We can see all of these are on the daily, and they are holding significant levels of support, moving to the upside. You could draw a descending triangle on probably most of these if you are looking at the smaller time frame, but it does look like, especially with the ASX and the DAX, that we're making or trying to make a new high, or at least targeting the previous high that we hit back in June-ish 10th, maybe 11th. But that's the overall structure of basically the global markets. It looks like it's a risk on move. Global investors are seeking to put capital in risk on investments, which is overall pretty good if you are long stocks. You don't want to be putting your money in safe haven currencies. Gold and silver does look good, but if this risk-on environment continues, it would be a little bit hard for gold to move up, but we will see. Let's now continue on to a little bit of some oil and some bonds. Christian says, does non-farm payroll or NFP affect gold and silver? Yeah, so I definitely think that it does. Gold especially, because gold is the primary asset for a store of value, while silver is definitely more speculative as a metal. So yeah, I definitely think that it could impact the price. Gold is definitely a risk-off asset, so obviously if the non-farm payroll is extremely terrible, you'll probably see gold do better, you'll see USD do better, you'll hopefully see stocks do worse if things are somewhat normal, but we've seen things like job losses and continued job losses be absolutely terrible, but then the market still booms and it still goes up. So at this point in time, because there's such a big discrepancy between the actual economy and the markets, because of the fresh injection of liquidity, fresh injection of liquidity due to stimulus from the Fed, as well as the new retail money coming into the market, it's really propping up and really showing not even the same thing. Like the economy and the stock market is definitely really far away from each other. Although the economy, in terms of the actual economic data that is coming out, is looking more positive. Like the PMI numbers were above 50, I believe, in the States. which is an expansion. Under 50, like in the 49, 48, it's a contraction. So overall, it does look a little bit better. So it makes sense that the stock market is going up, but it's not like we are in a place where there's no uncertainty there. Everything's fine and dandy. Everything's looking great. Obviously, we're definitely far away from that point in time. But in terms of right now, where the current market is, it does look like there's more opportunity and risk on investments. And that's where I'm currently positioning myself. So in short, I do think that it will definitely impact gold. Silver, not as much. All right, so that's a little bit of the global indexes. Definitely look like they are moving up. So overall, it makes sense that it's going to be a risk on environment. Quick look at bonds. So not a whole lot. We do see that the 5-year yield dropped below support, made a new lower low. Possibly retesting this as a resistance. We would need to see that validation dumping down. And if this moves to the downside, yields dropping means that there's global investors seeking to go in yields because there needs to be less yield in order to incentivize investors to park their capital in this instrument or in this asset. So we'll see where it goes. Right now, we're just slowly moving to the downside, but not really seeing any momentum. And not a whole lot to comment on it, really, on bonds overall. We're just consolidating, had a bit of a bump up, bit of a bump down, but not really seeing much movement. So the next thing we're going to talk about is the US dollar currency index. It's a pretty important thing to be looking at if you are a global macro analyst. All right. Christian says, okay, guess that explains the huge candles in silver. So if you're talking about the recent candles, yeah, so silver had a pretty big move to the downside. Gold did as well, where gold had a massive sell-off, breaking support, rallied right back up. If you're looking at a large time frame, it's going to be just a wick. But if you're looking at, for example, the hour chart, you do have candle closures on the bearish candles, and then you got the massive bullish candles that are showing a lot of strength buying those dips. So it does look good. But yes, silver definitely is more volatile compared to gold. If there's a metals bull market, silver will appreciate at a faster rate compared to gold. That's when you see the gold and silver ratio drop and decrease in the ratio. That's when silver is appreciating greater than gold. You saw that in many parts of the 1970s, especially in the late 1970s, when silver was absolutely booming. Gold was doing great, but silver was just doing better. It's kind of like a crypto bull market. Ethereum or Bitcoin was doing awesome in 2017, but there was some alts that were doing better than Bitcoin, right? That's kind of how I view the market. There's like primary assets like BTC and gold, and then there's like secondary assets within an asset class like some alts or like silver or other metals. So now we're going to get into, let's just read the comments, no more real comments. So we're now going to get into DXY, which is the US dollar currency index. We did get that validation of that higher low, which is great. I really wanted to see a validation where the series of higher highs gets one more test from the series of higher lows getting connected by an ascending trend line, which is our support. So that's really great. I'm really happy about that. So now this is a valid ascending support zone that I can use. We already talked about this yesterday, but we're going to quickly go over the two different situations here. If the US dollar currency index goes down, this would be, you could call it an ascending triangle breakdown. You can call it an ascending wedge breakdown, but it's a continuation of the impulse push to the downside that initially occurred within this major symmetrical triangle pattern. So if it breaks to the downside, that's going to be weakness for the dollar. You're going to be looking to go along on gold. Silver's probably going to be doing well. Overall stocks are going to be doing well. Crypto is going to be doing well. That's the environment in which US dollar falls, because the US dollar is a safe haven currency. If there's worry, if there's uncertainty in the markets, people are going to be putting their cash or putting their capital in US dollars, right? That's what happened in the last major meltdown back in March. You saw Canadian dollar go down, Australian dollar go down, New Zealand dollar go down, a lot of these different minor currencies and exotic currencies go down, and a lot of people flooded into the US dollar. So in the flip side, if US dollar is weak, a lot of those other currencies that we just talked about are going to be stronger than the US dollar, and that's what we're currently seeing right now. So if this falls, I'm going to be looking at overall bullishness within a risk on environment. But if it does hold this higher low, hold another higher low, breaking the 97 in terms of the DXY and move to the upside, this could be an ascending triangle breakout to the upside where it's going to be shifting our momentum from the downside. This is the consolidation. You could argue that this is a nice basing formation, although it does look like an ascending triangle. And then once it breaks to the upside, validates the previous resistance as a new level of support. That could be a situation if the SPX and the overall stock market is looking weak. Could be a situation where we would be looking for risk off trades and overall exposure, because if the DXY absolutely rockets, stocks are probably going to be going down. Bitcoin's probably going to be going down. Gold probably going down. We'll see where it goes. Gold's a little bit of an outlier in my personal opinion. But stocks, crypto definitely going down. And we'll be probably seeing those same currencies like the Australian dollar, New Zealand dollar, even like the exotics, South African rand, Russian ruble, Turkish lira. They will be dropping like a cliff if the US dollar strengthens aggressively. So that is the outcome for this potential structure. It's on the 4 hours, so we don't exactly know just yet, but it will be in confluence with the other overall market moves that are going to be potentially playing out, in my personal view. So those are the two different situations. I don't really see anything right now that would make me want to act on anything, but that's basically the two plays that I see within the DXY. Not a whole lot on the COVID cases. We got another 14,000 deaths, unfortunately, but we're not going to touch on that too much. All right, so after that, we're now going to get into gold, silver, and a little bit of crude oil. So we can see that it is hesitating. We're not seeing that initial push to the downside that we would love to see, but it's still holding supports for silver. Gold got a little bit shaky, a little bit noisy. I don't love it, but silver is still holding our nice respected zone, so I'm not really going to be doing much. It's still holding below the previous support and resistance zone as a new level of resistance. So overall, it's looking pretty good. Still made a lower high. If this does shoot towards the upside, probably the trade is not going to be valid anymore. It's going to be a fake out. It's going to be something in where we thought something didn't work out. That happens in the overall market, so you just got to take the loss and move on to the next great setup. But there's not a whole lot for me to really go over. Basically, the trade set did move down a little bit lower than I'd like. I'd like to see it hold this zone in an ideal world. This zone right here, it didn't really do that, obviously. We are coming back up to that zone. If we are looking on the 12-hour chart pullback, we still could get that push to the upside. So I'm just going to leave it and see if we get that strong initial push to the upside to kind of start the momentum up. That would be nice to see. But that's overall trade for silver. Not a whole lot more to discuss. And then gold looks definitely less ideal. The fact that we broke way below the zone, pumped right back up. We are holding this nice support zone right here, so it does look like we could still be in play. Let's just delete this zone. So at this point in time, gold is a lot less ideal for me just because it got a lot noisier than I would like. So silver is basically the only play that I see right now within the metals market that I'd like to play. So we'll see how it goes. Obviously, if you're in a trade, you just wait it out. You got your trigger to get out, your trigger to get out on top. So we'll just see where it goes. All right, so last thing we're going to be looking at for the commodities is US oil, or Western Texas Intermediate. Not a whole lot to talk about. We did climb back up to the key level of resistance, although we did see rejections at around $40 and let's say 50 cents on US oil, and we're right near that zone right now. So we're at an area where there's high levels of supply. Doesn't mean that it can't continue grinding upwards, but this is the current structure that I see within the market. Is we do have a consolidation sideways, but it could play into an ascending wedge. But right now on the daily, we just see wicks to the upside, wicks to the downside, candle closures on the previous resistance, candle closures on the previous support. So we're just consolidating sideways. If it breaks above the zone and holds the zone above 41, that would, or at least 40, that would be a potential breakout in which we'd be seeing a little bit more of a higher high and then continuing the ascending wedge. But if it holds this $40.40 or 50-cent resistance, I'm going to be looking at this market as just a consolidation sideways, which is a pretty easy way to go about looking at the market. So that is US oil. All right. Gonna get a little bit of coffee. If you have any questions, drop them in the question section or the description or whatever you want to call it, and then I'll be able to answer you. All right, some good coffee there. All right, I think I will leave silver on here. And then we're now going to talk about some crypto. So if you have any questions about crypto or anything involving the space, definitely throw them in the comments and we'll be able to discuss, talk about it, and chat. I'm just going to see some. All right, so let's now talk about crypto. So this is the crypto market update now. We just talked about some global macro stuff, looking at risk on, risk off. So now is the time to talk all things crypto. So good friend and awesome Discord member Mitch Trades actually pointed me to a really interesting Bitcoin volatility chart. And I think we'll start off with the Bitcoin volatility chart. I didn't know it even existed until this morning. And instantly when I saw it, man, this is really cool, because we're going to be using this Bitcoin volatility chart very similar to how we use the VIX for the S&P to understand overall risk on, risk off analysis. And this is right here. Might be a little bit too much when you first initially look at it, but let's just explain what we're seeing here. So first off, this orange line is the price action of Bitcoin, roughly. It is divided by the Dow Jones just so I can get it into a lower number. So instead of having BTC compared with US dollar, in which the answer will be around 9,000 units of US dollar to purchase BTC, this is how many units of the Dow Jones does it take to buy one Bitcoin. And right now it takes around 0.35 shares of the Dow Jones index in order to purchase Bitcoin. So the charts are closer together, and that's just all I wanted. If I just put Bitcoin as BTC USD, the chart of Bitcoin would be all the way up top and it wouldn't really line up well. So that's the only reason why it's down here. And then the top chart right here is the new chart that I got introduced to by Mitch. And this is, you can find it by just typing in BVOL, BVOL, and then you can find the one where it's a continuous, or you can find the 7-day. I personally will be using the 7-day average for the Bitcoin historical volatility index. So first things first, what do we see? I just indicated, well, we got two columns and rows, basically, I guess you could call it. The rows are going to be this big red line and this big green line. So the big red line is around 20. So this is when the volatility increases over 20. And what I did is I indicated with these red rectangular zones when the price was at a very high point of volatility. And then where I placed these green zones is where there is extreme low volatility, where there's very, very little price movement occurring within the marketplace. And when you line up the volatility increases and decreases with the price action, it gives you some data that you can work with. And I find it extremely cool. So let's look at this right now. Let's just quickly look at what happened before, right? It makes sense that the peak of when BTC was on 20K, right after the blow-off move, you saw very, very high volatility. That makes sense. The next time you saw low volatility, meaning the volatility was below 4.5, just looking at the average, was right before we dropped the 6K range. Remember that we were in our big, big triangle above 6K, and around like October, it was like zero movement almost. And that's when we saw extreme low volatility. What happened right after, right? We saw an extreme volatility increase to the upside. So you see these two extremes. When it goes down one way aggressively, it pushes up basically to the high where we're saying this is very high volatility. So it went from low to high extremely, extremely quick. These are times when you just let things run and you can just absolutely balloon your portfolio. If you let winners run, you obviously need to manage risk, and if you're leveraging 2-3 times in these certain circumstances, yeah, you can do really well. But from massive decrease in volatility to massive increase in volatility is something that we want to keep an eye on. Same thing here. It's a lot less aggressive in the speed at which it went from low to high, but we saw very low volatility again right before we had the April boom breaking the $4,300 zone for BTC. We had extreme low volatility, and what happened after that? We had a massive increase in volatility as we climbed from the 4.2K resistance break all the way to around 14K. So we went from extreme to extreme. We went from extreme to extreme. And right now, in my opinion, we're going to go back to the extreme low volatility. We didn't really see that much low volatility here. It's pretty well in line, but what I'm looking for is a break around 4.5. We saw 2 breaks below 4.5, and after those points, we saw extreme volatility come into the market. Yes, you saw extreme volatility here, but now you're seeing the volatility decrease, which in my opinion is a good thing. You need these market breaths, these situations and these times when market really consolidates extremely tightly, because there's times where markets are in equilibrium and there's times where markets are very, very skewed and controlled either by the buyers or sellers. And that's what a market is. You can't have a market where there's only buyers all the time, right? And you can't have a market where there's only sellers all the time. There's going to be mixes of up, down, and going sideways. And it's pretty healthy to see the going sideways part. And what we're going to be looking for after it drops, reduces in volatility some more, is that I'd like to see a shift where you're going to get a massive shift. We're going to see high volatility come here in the near future. It's just a matter of if we're going to go down or up. I personally think just from a technical standpoint, we have a higher possibility of going down. But in terms of volatility, that's what it's showing us, is we're decreasing in volatility. And if it drops below 4.5, we might see some extremely, extremely low volatility. But once you get the initial move either to the upside or downside, where you start to see the momentum and the direction of the trend initiate, that's when you want to jump on, look for those continuation patterns, and carry the trend. Because usually after these very low volatile times, you're going to get these big spikes in volatility. You can see that right here, you can see that right here, and that's what we're looking to capitalize on. So once we do see the initial major move either to the upside or downside, I think that direction will continue quite aggressively. And that's information that's very useful when you're looking at it from a macro standpoint. So that's going to be how we're looking at BTC as of right now. So I want to see decreasing volatility. I want to see the funnel get deeper and deeper and deeper, so it's contracting the volatility, contracting the movement of the price, so it gets into such a small range that this drops to around what we saw at like under 2 or like under 3.5. That would be extreme low volatility. And what comes after extreme low volatility usually is you're going to have these big spikes where there's going to be a huge move, where there's going to be either a massive strength from either buyers or sellers, and that is what we're wanting to capture. Great chart by Mitch. Thank you very much for presenting that to me and showing me, because I really, really like learning new stuff basically at the end of the day. All right, so we're going to get into a little bit more of some BTC analysis. This is going to be looking at the BTC open positions, long and short. If we zoom back all the way here, we see that there was a massive boom in just Bitfinex exchange, open positions, massive dump, massive move, very volatile. But what specifically I'm looking at right now is how little of open interest there is. We see that there's not a lot of positions being opened in both the longs as well as the shorts. We're almost at the lows for the shorts here, and we're almost at the lows for the longs. So overall, there's not a lot of positions being opened right now if you're looking at from the daily standpoint, which is, in my opinion, a good thing because it's creating confluence with the overall lack of volatility that we're wanting to see until we get to a point where we're not really moving much. You know, even day traders, intraday traders are not able to profit because the moves are just not strong enough. And then at that point, you're just wanting to be patient. You don't want to be anticipating a move either up or down. In my opinion, you want to see the follow through. You want to see the initiation of the momentum from the extreme low volatile situation that we're currently in, or that we're going to be in even further from where we are now. And once that momentum comes in, then you're looking for those solid entries to carry the momentum, in which hopefully by the time you entered, the volatility is increasing and the movement towards the intended direction is the volatility that is increasing. So if it's going to go down, hopefully you already entered, and if volatility is increasing, you want the price to exponentially go further down. So it's increasing in volatility. And that's the situation that gets you those awesome gains. So that's what we're going to be looking for. I think a next setup is coming into play for BTC shortly, but I just think right now we're just in a trading range. We're just consolidating. I want to see the momentum shift before I really jump in. So that's a little bit of, not really TA, but just looking at some other data points that, in my opinion, is pretty important. Not a lot to talk about on the market cap, sorry, not the market cap, the BTC dominance, or the dominance of Bitcoin as a market cap compared to the overall market cap of crypto. Not a lot has happened, right? So we're still holding our supports, not really seeing much. Even if we zoom out a lot further, we can see that we're making low, higher low, higher low, higher low, higher low, higher low, higher low. So we're making some higher lows. We are squeezing with a series of lower highs into the apex of the structure, which is around 67% in terms of the BTC dominance. If this breaks to the downside, that means that there's going to be capital getting taken away from BTC and put into alts, which is more speculative, more risky, and represents risk tolerance increasing in the cryptocurrency market, which is a bullish sign. If this goes up and you see the BTC dominance increase, it means that overall capital flows are getting taken from alts, injecting into Bitcoin, because people know that Bitcoin stores value better than almost every single alt in the market, and it's had the test of time compared to basically every single other alt that hasn't been as resilient and has not been around for as long as BTC. So that's my view of the BTC dominance. We're not really doing anything right now, and I don't mind that. Like I said before, we're wanting to see the contraction and volatility further so we can see an extreme reduction in volatility, so then we can go from one extreme to another, and that creates opportunity. All right, so and that said, we're not really going to be diving much into the price action because we are expecting the consolidation to continue. We see a nice zone of confluence at around 8,900, where you see previous resistances. If we just extend that a little bit further, resistance turned to support, resistance, support, support, support. So we got a horizontal zone at around $8,900 for support, and we do see the candle is closing with a type B right at this ascending zone. So we're not seeing on the daily chart a candle closure below this ascending support zone. Obviously, we do still have 4 hours until this candle closes, but if it does close around where we are, we're closing at this type B with another type B, which is in confluence with the ascending zone. So I don't classify this as a breakout yet. It would be nice if we saw, let's just get our, that's not it, the brush. It'd be nice if we saw this just come in further and further and further and consolidate and consolidate. That would be awesome, because that would mean that we're going to see a decrease in the volatility of BTC, which is what we're looking for in the next big trade. We're looking for decreasing volatility until there's that one crack, there's that one main push, and then you're wanting to see continuation of that push. Kind of similar to what happened in 2018. Let's go all the way back here. You see there is very, very low volatility here. Not a lot of price movement, right? This is when volatility was at its extreme low if you're looking at volatility of BTC. Then you saw the first impulsive push to the downside, breaking the support, breaking the market structure, extreme aggression, right? This is what you're looking to trade, this continuation pattern right here, right? This is the hesitation from the buyers and sellers, and will provide a potential continuation setup that will give you an awesome risk reward structure. Let's say you have a risk reward here that's like 5 to 1, 6 to 1, and if you get stopped out, and if it goes back to the initial retest zone of like 6K, okay, well, you lost that one, but if your risk reward's at a 4 to 1, 5 to 1, 6 to 1, you can take 2 trades. That's totally fine, because you know the risk reward is so in your favor that you can afford to take a loss or 2 losses, because you have a high probability of that continuation going in the initial aggression move to the downside, and that's what I'm going to be looking for. It could be the upside, but my senses are telling me that it's going to be moving more to the downside. It's just a higher probability in my personal view, and it's really topping here, like we saw within the BTC bottom, where you saw a series of lower lows and then some higher lows, testing a major level of resistance. Once you get that initial push, and this would be a continuation pattern. This is an ascending channel. You can call it an ascending wedge, a melt up, kind of like that, and that's a structure that we'd be looking for potential long. And you could look for a descending wedge melt down if it's a similar sort of structure. But you see this bottoming, this nice bottoming pattern, and then you see a massive acceleration in the new trend, and then you get the continuation pattern, and then you get the meltdown or the melt up, whatever you're looking for, right? So that is a similar situation we're looking for. Is you see this nice horizontal zone. This is an ascending zone. You can also use the 85. So if it breaks down here, and then maybe let's just draw it in yet again. It's right here. So if it breaks down and then kind of forms like this, you can extend this out further, and then you get the nice bottoming pattern like this, and then the $8,500 zone is your breakout. So then what you'd be looking for is like breakout and then some continuation pattern, and then you're looking for some entry somewhere in there. Ideally, I don't exactly know what this is going to look like. It could be an ascending triangle, it could be a channel, it could be a wedge, it could be an ascending channel. Whatever it is, you're looking for continuation patterns, and that's what you have to backtest. You got to know your strategy and everything, but that's what I'm looking for within this current structure. Ideally, we'd like to see it consolidate a little bit further, but I think if you're looking for shorts, it's a little bit too early, and if you're looking for more dependability and a higher win-loss rate within your trades, waiting for the $8,500 break would be, in my opinion, the highest probable situation that you can take for a long. You saw the same thing kind of here, right? Where you could be looking at this as your major zone. You could be looking at a potential zone right around here or here. You know, you can kind of find it either way. But what you see after is a nice continuation pattern, right? Where you see either an ascending zone right here. You could draw a potential horizontal zone right here. You're looking for a potential descending zone right here, but obviously this is a daily chart, so it's pretty hard to tell. But you're looking for hesitation where the bulls are creating a bull flag or bear flag, sorry, and just a hesitation, right? You can't go from point A to point B without having some corrections and some pullbacks. And we're wanting to enter on these, which is the completion of the exhaustion phase before the next impulse phase to the downside. So that's what we're going to be looking for. It's not going to, well, I guess in this situation, it literally went from 78 to like 5 in one bar in a single day. That usually doesn't happen. It usually waves down. Like even with this massive sell-off, you see waves, right? So that's what you're looking for. And that's the optimal trading environment, where this is not the optimal trading environment. This is like manipulation, massive pump and dump craziness, which I don't like to be a part of personally. If you have a short in, obviously you're making absolute bank, but like if I see this going down, I'm not thinking, oh my god, I gotta get in this. I'm thinking, okay, I just want to not be in this until it's proven to be a little bit more, I guess you could say, not like easily understandable, but it's more normal. It's less, I don't know exactly the word to put it, but this isn't normal market structure. Like, it's really hard to say, okay, I see it absolutely dumping. I'm going to enter here and I'm going to take my profit here. Like, how do you structure this trade? Where's your take profit? Are you going to get wicked out and then moving back down? It's just there's so much uncertainty in these massive sell-offs that unless I'm in it, if I start seeing it absolutely dump, I'll just assume that I'm not in it. I'm totally fine. There's probably going to be some continuation pattern that's going to give me a little bit more edge in the market, and that's how I like to play it. All right, so that's going to be my overall analysis for BTC. We could go on a smaller time frame, although there's not a whole lot to talk about. We see major resistances up top. We see a descending zone. And initially, we did see a little squeeze here, and I thought we would potentially hit like the $9,400, $9,500 zone. A little bit surprised because the S&P is doing pretty well. It hit the resistance that we talked about at the beginning of the video, and BTC is not really seeing that correlation where there's a strong buy volume coming in. So what we're going to be looking at quickly is just the correlation of BTC within the S&P 500 just to see if it's decreasing. If it's decreasing, that's kind of a good thing because we want, in the long run, to see BTC look more like a risk-off asset or instrument. Because I think inevitably currencies will fail, and that's an extreme risk-off sentiment. If currencies fail, where the fuck do you put your money, right? If stocks drop, if real estate drops, people always think of cash as the safe place to store money, right? But if cash is the one that is, in a burning house, where do you keep your funds? And that is where you could have the biggest bull run in gold, silver, and crypto in history, because in the globalized, financialized world where there's a lot of derivatives, a lot of paper money, there's a lot of debt as well. So, okay, not too much on that. Let's just look at some correlations between BTC and the S&P 500. On first, the 90-day chart, we do see a little bit of correlation, but we are seeing overall decrease in the correlation between traditional assets that are risk on, like the S&P 500, and BTC. But overall, we are seeing a positive correlation of around 0.21 in positive correlation, which is pretty correlated. 100% correlation is like S&P is 100% correlated to S&P. Obviously makes sense. Bitcoin is around, let's say, 21 or almost 22% correlated within the S&P 500, which is pretty correlated, right? So you got to look in that. Actually, let's look at the 180-day. The 180-day is still increasing. We're at over 0.22% or 0.22 correlated positively if you're looking at 180 days as a time frame. So the fact that we're that correlated, looking at such a long time frame, definitely indicates, to me at least, that Bitcoin is considered currently a risk-on asset that global investors use to speculate when there is an environment in which people are looking to seek out risk. Let's close this. And let's close this. And that is the end of the video. If you have any questions, definitely drop them in, and we'll be sure to, look at them, answer to the best of our abilities, and to give you our views, opinions, thoughts on the matter. So I'm going to just put this a little bit further so you know that there's a level of support there in line with this zone right here. And I'm going to take this off, and I'm also going to take, I'll keep that on. And this should now be visual order sent to back. Get that green because that's going to be our support zone. Okay, so we got a nice little support zone. I might shift. No, I'll keep this ascending zone because it's well respected all throughout. This is currently below the zone, but we are looking at different exchanges. It is right within the zone. I don't actually have the Performante volume indicator on here, which I just opened up my chart recently, so I should put that on. But anyways, that is basically the video. So I'm not really going to dive too much into it because we already talked about the larger time frames, and I'm sticking to it. Ideally, I'd like to see that volatility increase just a little bit more before we really get into the major moves that could be coming into the market. Quick look at the total too. Overall, alts are not seeing a surge in demand. They're actually decreasing kind of near the support of the market structure we see within the Altcoin Market Cap. If it does break below this support, probably going to be a potential resistance, and then this head and shoulders could play out for a potential reversal, but we got a lot of time until that does occur. So not a whole lot of interest in alts from the looks of it right now. And then ADA, which is the alt that we looked at yesterday, really, really nice rejection. We were initially looking at that rejection when price was like just at the top there, and I just said I'm going to wait it out. I don't need to enter. There's no FOMO needed here. Came back perfectly to retest this zone, so that worked out awesome. My initial zone that I was looking at was looking something like this, where you get a breakout, you get a validation of a previous resistance turned into support, and you're getting that next solid impulse push to the upside, where you're going to get the next target hit. So right now it's looking pretty phenomenal. If Bitcoin is at least consolidating, I think this could be a really good play, because as long as Bitcoin's consolidating and not moving to the downside, it's giving the option for alts to move up. But if Bitcoin is going down, you really will not see any alt appreciating. So that's the power of knowing what Bitcoin is doing first. So Bitcoin is able to hold, consolidate, decrease in volatility further. I think that ADA Cardano could be a good opportunity for a long for continuing the overall momentum. And we've already talked about it, that the catalyst for this trade is not just a break of the symmetrical triangle, but they are also going to be implementing or already implementing an upgrade within their project called Shelly. And you can learn more about that if you'd like, but they're going to offer staking, and they're going to be doing a hard fork at the end of July. So there's a lot of updates. There's a lot of new things coming into the world of Cardano, which is going to drive a lot of hype, a lot of potential interest, and a lot of news headlines. So that could be the potential play for this alt. And it also lines up pretty well with our technicals, because overall it looks absolutely gorgeous for a long. So that's going to be my overall analysis. Hopefully you enjoyed it. I don't really see any other questions coming in. Oh, Mitchell, thanks, man. Yeah, no problem. Thank you very much. So for anyone who is interested in the previous chart we did look at, this was by Mitch. He introduced me to the BVol. This is the 7-day. You can just look at 24 hours, 7-day, your own time frames, perpetual, whatever you want. But thank you very much for it, Mitch. I really appreciate new things that I'm able to look at. I always love being able to have more information come in so I can make better judgments. So Christian also says, thank you once again. You've always got the great content, plus the Discord group is on point. Really appreciate the comment, Christian. That means a lot to us, definitely. The team at Performante do try to provide unbiased quality analysis, and I think it's a pretty awesome place overall. Everyone's respectful, everyone's nice, encouraging, friendly, and really happy to call it, I would say, my digital home, my digital community. Not mine, but I'm a part of it, so I can call it mine. It's not just like a sole ownership or anything. But anyways, yeah, really appreciate that. That's great to hear. Loving that you are enjoying it, and we'll try to keep on going with it, provide more content, provide more information that makes it even better. That's really our goal. So I don't really see any more questions coming in. Really appreciate you watching, coming, and engaging, as well as just being a part of our community. If you are, we always do appreciate some warm welcomes. So going to close the video off here for the recording. I'll leave the TikTok and YouTube up for a little bit longer, so if anyone does have any questions, you can drop in the questions, but I will end the video here. So thank you very much for watching. For those who are on the recording, we do provide live videos, so you can watch it live, ask questions of what we're looking at, ask questions about the stuff that we're not even looking at, like individual crypto pairs, individual stocks, individual commodities, whatever the case may be. At the end of the video, we do a open, free Q&A and discussion and analysis. So definitely check us out and join in on the next one if you are interested in being a part of it. We do provide them at around 11 to 2, kind of like brunch to afternoon area PST, so Pacific Standard Time. So whatever time frame you're looking at, that is when we're going to be doing it. So don't really see much else come in. 4 people on YouTube. That's great to see. So it is definitely growing. And we wish you the best in the future endeavors for this upcoming week. And really appreciate everyone who comes in on a regular basis. Christian all the way from Australia. Great to see you on here. And hope to see you again. And hopefully you guys all have a wonderful day. Thank you for coming. And until next time, have a good one.